Hey, what's up, everybody? Welcome back to Investing Sucks. So, in this video, I'm going to be revisiting another company that I made a video on several months ago because there's recently been some very significant news that's come out related to Canada's federal budget that impacts how this business will perform going forward. And I wanted to take this as an opportunity and kind of use it as a learning experience and talk about what you can do when a company that you own gets hit with something like this kind of unexpected regulatory action, which is perhaps something you didn't foresee when you had initially invested in the company. And also just look at how you can approach analyzing a company that's now found itself in this situation and determining if it's still worth the risk. So the company in question is Goeasy here. So my initial video that I made on this company was around June of 2022, so around this time here. And we can see pretty much after I made that video, they had a pretty solid earnings report that came out, which led to this kind of spike we see here. It then fluctuate a little bit, and then it was around this time here where the federal budget was released, and we could see it's come down quite a bit. So what happened was something that investors in this company were probably aware of as a possibility, but they didn't think that it would become a reality as quickly as it did. And even as recent in their Q4 earnings call, which was in February, so only about a month before the federal budget came out, they specifically said that they had not heard of any upcoming changes in the regulation and that the probability of any changes happening is low. And then 1 month later, their stock is down, as we can see here, about 23%. So this was pretty unexpected, but I wouldn't exactly say it was unknowable if you were a diligent investor in this company. So basically, what happened, if we go to the actual federal budget here, was last month the government of Canada they released their federal budget for 2023, and there was a lot of climate change related policies in there. There was that one grocery rebate that got talked about quite a bit. But something else that was included was a reduction in what's called the criminal rate of interest. So this is the maximum allowable interest rate that can be charged on a loan, and it's getting reduced from 47% down to 35%. And there is a possibility, depending on the outcome of an industry consultation that's currently going on, that it could get reduced even lower. And it's all part of this theme that we're seeing in Canadian policymaking of protecting the consumer, really. So this is just another, I guess, instance of that trend happening. And basically, the argument that they made is that this 47% that was initially written into law was written in law during the 1980s. And that was a time when interest rates were a lot higher than they are today. As we can see, this is pretty much 100 years of history of the Bank of Canada's overnight rate. And it wasn't any higher than it was, or it was as high as it got in the 1980s, which was when this was initially set. And obviously today, interest rates are significantly lower than that, even with the recent hikes that we've seen. So they're basically arguing that that 47% doesn't really make sense anymore and it should be lowered to something a bit more reasonable. And this is a problem specifically for Goeasy because if we look at this is their most recent MD&A of their Q4 results. This is the total yield on their loans, and I'll talk more a bit about Goeasy just to make sure everyone's on the same page, kind of how they work. But for now, they're a company that makes personal loans, and this is the average yield on their personal loans. We can see here about just over 36%. And it's being reduced, the maximum, interest rate is being reduced to 35%. Now you may be thinking, well, it's just going from 36 to 35%. How bad can that even be? And the answer is it can be pretty bad because this is just an average, right? So that means there's a significant amount of loans that are going to be above that amount, as well as loans that are below that amount. And the interest rate gets set depending on the credit history of the person they're loaning the money to. So if, that interest rate gets capped, it gets artificially capped, then they're not just going to, suddenly start charging the same customers, just a lower interest rate, right? They're going to actually think about things a bit further and say, well, we can't, there's this whole cohort of consumers that we can't serve anymore because we can't charge them an interest rate that makes sense for us, where the risk we're taking on by loaning money to them, we're being adequately compensated for it. So we have to start, focusing on higher credit quality customers. So that covers what happened with Goeasy and why their business just got hit with a whole bunch of uncertainty. And what I want to do later in this video is show you an updated valuation of this company so we can try to understand what sort of return we can project going forward by holding this company under different, future scenarios, and then tie that back into what their valuation is today. Now, in order to fully understand what this change means for Goeasy, we have to fully understand the portfolio of assets that they hold, which is essentially their loan book, right? What loans do they have? What kind of loans are they? And what makes it unique in the first place, right? So Goeasy in particular, they specialize in non-prime lending of personal loans to consumers. So this can include things like the purchase of high-ticket retail items, auto loans, home improvement projects, and then there's also a easy home segment which is smaller for them, as we can see here. Easy Home accounted for about 15% of their revenue in 2022. So the other 85% would be Easy Financial, which is all the personal loans that they make. So their loan book is much different from a traditional bank. And we can see evidence of this if we just look at some basic metrics that you would look at if you're analyzing any bank or any financial company. So this is net charge off. So this is the percentage of their loans that ultimately they charge off so they don't get collected. And we can see it's at 9%. So nearly 1 in 10 loans that they write, they ultimately don't collect them, right? So that's obviously a very high risk from a lending standpoint. So that kind of explains why they charge such a high interest rate on their loans because they're extremely high risk loans and they need to be compensated for taking on that risk. Now, looking at them in terms of an actual valuation standpoint, by the way, if you're wondering what this website is that I'm using here, it's a website that I created called tickernomics.com, and I'll leave a link in the description of this video if you would like to check it out and use it yourself. But this feature I'm using here, it's in the Insight Tables feature. It's a custom table. So this allows you to basically, you can add tickers here, and then you can add metrics. So, price to book ratio, dividend yield, beta, pretty much any a number of metrics that we have here. And I'm comparing a few key ones here, but mainly I want to focus on the price to book value, and it's for a few somewhat comparable Canadian stocks. So these are all kind of financial stocks, and we can see we got EQB here, which is a company that I've talked about a few times on this channel, Canadian Western Bank, Laurentian Bank, First National, and what we see here is Goeasy has a relatively high price to book ratio, 1.7, right? First National is a bit of an outlier here at over 3, and we can see that's also coupled with the highest dividend yield at over 6% of all of them, and then the beta is little bit low here. But Goeasy also has the highest beta, right? So this kind of tells you that it's risky, right? Somewhat risky because the beta is a lot higher, but investors are valuing the assets, more highly than other, say, larger, banks that don't have as high an interest rate on their loans. So there is growth projected into this. Whenever you see a financial company that's valued over 1 in terms of its book value, there's a little bit of growth projected in there because anything below 1, then your investors are a little bit more conservative. Anything, 1 or 2 plus means, it's a faster growing one. Now, one very important development that we've seen happening with Goeasy throughout the past year has been this so-called de-risking of their loan portfolio. So focusing on more higher credit score consumers when they're making these personal loans. And we've seen this process unfold in their financials. So if we look here, the total yield on their customer loans, which we already saw in Q4 of 2022, was 36%. And then just 1 year ago, it was 41%. Now that's a pretty significant decline. And the reason that decline happened is because they're focusing on higher credit score customers, right? They're not just simply charging a lower interest rate to their customers because that's not how risk management works. If you're a company that offers loans and you just suddenly start charging lower interest rates, you're going to be out of business pretty soon because you have to charge an interest rate that is commensurate with the risk you're taking on. So that's one thing. Another thing is they're focusing on more secured loans. So we can see here the percentage of their loans that are secured has gone from just under 33% to 39% in the course of about 1 year. So those are two very key developments. And the reason that they started doing this didn't actually have anything to do with the regulation change happening because in their view, they saw the regulatory environment as rather stable. The reason they did it was because of this incoming recession that they had anticipated. Because they basically saw, if there is this recession that everyone's saying there is, it's just driven by higher interest rates and just less economic activity, probably an uptick in unemployment rates as well, then we're going to have to start, not serving the high risk customers anymore and de-risk our loan book. Otherwise, we could face some very significant losses. And as we've learned, over the past month or so, when banks face losses, or they're not really a bank, but just companies that offer lending products when they face significant losses, they can, it spells trouble pretty quickly. Now, I do want to take a look at the unemployment rate here and just show you what it's been pretty much in the past decade. So we can see here it was kind of gradually going down, and then that thing happened in 2020 where it shot up, and then it took a few years for it to normalize, but it kind of seems to be continuing on this general downward trend where it was kind of in 6.5 7% here in 2016, and currently it's only at about 5%, and it hasn't really changed that much throughout 2023, despite all the talks of the recession that we've seen been going on. And the unemployment rate for a company like Goeasy is very crucial, right? Extremely crucial. Because if you offer unsecured personal loans, any uptick in unemployment means, there's people unemployed. Some of those people are probably your customers if you serve millions of customers. Anyone who loses their job who has an unsecured loan is probably going to default on it because for most people, their primary source of income is their main wealth building tool, and it's how they would pay off any sort of personal loan. Now, one thing that I thought was interesting was the company defines four key macroeconomic variables that contribute to how they manage their credit risk, and when they're doing their estimates of how many loans will ultimately be uncollectible, they look at these main things, which is obviously the unemployment rate. Inflation rate is another one because that just means people have less money in their pockets. It's going to be harder to pay back loans. GDP, which just ties into general economic conditions. And then interestingly, the price of oil, which I'd imagine this has a much greater impact in Western Canada because that economy is very dependent on oil, and if oil prices are high, then there's usually more economic activity in those areas, and people would probably be a lot less likely to default on loans. So overall, in hindsight, it's great that management has already started that process of de-risking their loan book because, as it turns out, they were eventually going to have their hand forced to. So it's a pretty interesting development, and it kind of shows that, while this change in regulation is bad for them, it's really not the end of the world, and they were already sort of doing it. Okay, so the last thing that I want to do in this video is show you my updated valuation of this company. So this can help us understand if this company is still worth investing in given the recent developments that we've seen. So what I'm showing you is this Excel sheet, which is pretty much the exact same Excel sheet that I showed in my original video back in June, except I've updated for this new information that's come to light. And it's a pretty simple valuation model. It's actually very simple. It's not like a DCF model, which has a lot more moving parts. This is really just looking at what earnings have been in the past, what shares outstanding have been in the past, and then we build some sort of a reasonable estimate of what it will be going forward into the year 2028. And then we basically calculate EPS by just simply dividing earnings by shares outstanding in the year 2028. And then we apply a multiple in that year, pretty much a PE multiple to see what their share price will be. And we have multiple scenarios here because obviously we don't know exactly what their PE multiple will be. But we can put, a few scenarios so we can understand, what our returns would be given those different scenarios. So this is how it looked currently. I've revised the share price down a little bit, so our returns are a bit more attractive because we're getting the same business at a cheaper price. But obviously things have changed, right? This 20% growth that I had initially may need to be revised down. So I kind of thought, how can we go about approaching this, right? And there's one thing you can do, is just guess, right? But I would try to avoid doing that. I would, take the time and really read through, the information the company has provided you to understand the relationships between different financial information they provide, so you can build some sort of an estimate. Usually, if you really think about, the disclosures a company has and you pay attention to them, you can usually find some way to devise, some reasonable projection of what their revenue will be. So what I'm looking at here, this was the guidance they released in their year-end Q4 call. So for the next until 2025, this is what they're projecting in terms of their gross loans receivable. So the total amount of loans that they have outstanding, their total revenue for the company, and then the total yield on their customer loans. Now, this was released before the federal budget came out, so obviously this is probably going to be revised down. This is probably a little bit more optimistic than what is actually realistic for this company. And we can even see here, they're saying a lot of the yield on their customer loans is above that 35% threshold, which obviously, as we now know, isn't going to be possible. So there's two things that are going to happen. One is the yield in their loans is going to have to be revised down, And two, their gross loans receivable is going to have to be revised down as well. Because, like I said before, there's this whole cohort of these higher risk customers that they can no longer serve because they can't just serve the same customers a lower interest rate, an artificially lower interest rate. The interest rate has to be commensurate with the risk they're taking on. If they start doing that, then they're going to get in trouble pretty soon. And what I was really hoping that they would show in their disclosures would be something that shows the percentage of their loan book that has, what interest rate attached to it. So something like what percentage of their loans has a 15% interest rate? What percentage has a 25, 40% interest rate? Because then we can see what percentage of their loans are going to be impacted by this. And we can see the breakdown of, how, I guess the breakdown of how the riskiness of their customers, right, given the interest rate that they're charging them. But what I kind of infer from this is if we take the gross consumer loans receivable and we multiply it by the total yield on customer loans, we get somewhere pretty close to what their projected revenue is. So if we can make revisions to gross consumer loans and the yield, then maybe we can get an updated estimate of what their revenue will be, and then we can apply a net income margin to that revenue, and we can determine what their earnings will be. And we can get within the ballpark, right? It's obviously not going to be perfect. And it's also important to note that this is just the top of their income statement, so their revenue here for the year end of 2022. Not all of their revenue comes from simply interest or leasing revenue. They earn some commissions, which make up about 18% of their revenue, and then a small part of their revenue is, I guess, fees. So it's not perfect, but it gets us within the ballpark because if we multiply 3.4 billion here of their gross loans receivable by 34.5% yield, we get, somewhere around this range of 1.2, 1.1 billion in revenue. So let's revise the average yield down to 30%, right? We revise the loans receivable down to 3.2 billion. We get revenue of about 960 million, so just under $1 billion. We then apply a 19% net income margin to this, which I got by taking their adjusted earnings for fiscal year 2022. And adjusted earnings just removes the impact of one-off items. So we get some more normalized earnings figure, divide that by their revenue, and we get about 18.9%. So we can reasonably assume that this will be their net income margin going forward, which is pretty strong, right? That's a pretty high net income margin for a company like this. Under those scenarios, we get estimated earnings of 181 million for 2023. Now, if we project 20% growth for 2023, we get 168 million. So we're actually being a little conservative currently with this 20% growth. But the problem is this 20% growth compounded in the future years balloons up to about $420 million in 2028, which if this company continues to face, real regulatory headwinds like this, and who knows if the outcome of the current industry consultation that's happening, this could get revised even lower, then personally, I think this should be revised down to something more reasonable. So let's say we go to 15%, and let's look at what returns happen now. The returns don't look quite as good, right? Personally, I'm looking for somewhere in the range of 15 to 20% return. That kind of compensates me for the risk I'm taking on by investing in this company. And we're not getting that currently. We need the stock price to be quite a bit lower, probably in the 80s or high 70s for that to happen. But if we still are okay with a 20% growth in earnings, then under a 10 PE ratio, then the returns are looking pretty good, right? And this is about a 6-year return. So the point of this part is not for me to tell you what you should value this company. It's to help you understand the relationships between, what we saw happen with the regulation, how that impacts them, and how you can think about revising your estimates in this company if you are interested. And it's an important exercise because if you are taking investing seriously and you want to invest in individual companies, you want to have success investing in individual companies, you need to know how to manage these types of unexpected things that happen. And you need to know how to make rational decisions under pressure, because if you don't, then eventually you're going to end up making a mistake, right? And your mistake in the market is someone else's opportunity. So for me personally, this is going to be a pass just because it seems like there's a lot of risk with this company, and it doesn't really seem like the share price compensates for that risk. based on what I'm personally okay with assuming, in terms of earnings and shares outstanding. Maybe your assumptions are different. You disagree with me. That's fine. That's how the investing world works. But for me, this is going to be a pass for me. But nonetheless, I hope you did find this video useful and you did get value in it. If you did, then please leave a like. And if you're new to my channel, I'd appreciate if you would consider subscribing. And I'll see you guys in the next video.